Question 1. Compute Pitman Company's break-even point in dollar sales for next year assuming A. The agent's commission rate remains unchanged at 15%, B. The agent's commission rate is increased to 20%, and C. The company employs its own sales force. So in order to get the break-even points, I'll need to know the fixed expenses, contribution margin, and contribution margin ratio. To get all the fixed expenses, I added marketing expense, administrative expenses, and interest expense, which made the total fixed expenses $5,267,000. To get contribution margin, I used the sales, which is $18,500,000, and 15% of that is $2,775,000, which was subtracted from the original sales amount and got $15,775,000. Then you got to subtract the variable expenses from the sales, and that number is $8,325,000, which makes the contribution margin $7,400,000. And to get the contribution margin ratio, you have to divide the contribution margin by the sales. So $7,400,000 divided by $18,500,000 makes the contribution margin ratio 40%. So to conclude for answer 1A and to get the break-even point, you have to divide fixed expenses by contribution margin ratio. So $5,267,000 divided by 40% gets you $13,167,500. Question 2 wants to know what the break-even point if the agent's commission is increased to 20%. So you have to find a new contribution margin, which would be the sales of $18,500,000, and the 20% of that is $3,700,000. So you subtract it from the sales, which is $14,800,000, then subtract the variable expenses of $8,325,000, and you get the new contribution margin of $6,475,000. And then the new margin ratio is $6,475,000 divided by $18,500,000 and makes the new contribution margin ratio 35%. So to conclude for answer 1B, to get the break-even point with the increase of 20% commission, you will divide $5,267,000 by 35%, and the answer will be $15,048,571 with the new break-even point. Question 3 wants to know what the break-even point is if the company employs its own sales force. So in the next few slides, I'm going to get the new fixed expense amount and the contribution margin and contribution margin ratio. The new fixed expense amount will change because you need to add $2,775,000 to the fixed expenses and subtract $85,100 from it because you'll no longer have auditor expense. So the new fixed amount will be $7,956,900. And then to get the new contribution margin and ratio, you'll subtract the agent's sales commission of 7.5% from the $18,500,000. So after you subtract the $1,387,500 from that, the new commission sales will be $17,112,500, and subtract the variable expenses of $8,325,000 from that, and the new contribution margin will be $8,787,500, and the ratio amount will be 47.5%. To conclude for answer 1C and to get the break-even point, you will divide fixed expenses by the contribution margin ratio, so $7,956,900 divided by 0.475, you will get the answer of $16,751,368. Question 2 wants to know that if they raise the commission rate to 20%, what is the dollar sales amount they will need to be able to get the same net income of $2,133,000? So to hit that target profit, you will need to add fixed expenses and target profit and divide it by the contribution margin ratio. So the fixed expense amount is $5,267,000, and you will add the target profit of $2,133,000 and divide that by the 20% commission contribution margin ratio of 35%, which gives you the answer of $21,142,857.
Hello everyone, my name is Prescott and I will be here to discuss questions 3 and 4 with you. So what we got here for question 3 is determine the dollar sales at which net income would be equal regardless of whether Pittman Company sells through agents at the 20% commission rate or employs its own sales force. So here we got the work drawn out for question 3. We're going to start with the total cost at 20% and equal it to the total cost at their own sales force. So now if you drop down below, we have 0.65x plus $5,267,000 is equal to 0.525x plus $7,956,900. So where the 0.65 and 0.525x come from is that is our variable cost ratio, and we get that by taking the variable expenses at each commission rate and dividing it by the total sales at that commission rate. So if we do that, we get 0.65x for the 20% commission rate and 0.525x for the own sales force. So then we're going to do some basic math here. We're going to subtract $5,267,000 from each side, which leaves us with 0.65x is equal to 0.525x plus $2,689,900. And of course, we're going to subtract 0.525x from each side, which leaves us with 0.125x is equal to $2,689,900. Then we're going to divide each side by 0.125, so we get the x alone, which will be our answer. So if we do that, we get the answer of $21,519,200. This brings us to question 4, which is a 3-part question, and it is compute the degree of operating leverage that the company would expect at the end of the year, assuming the agent's commission rate remains unchanged at 15%, it remains unchanged at 20%, and if they were to employ their own sales force. And here for these questions, they want us to use the income before taxes when we're calculating the answer. So this is part 1 of question 4, and what we have right here is the degree of operating leverage formula. What that is basically just the contribution margin over the total income before tax, which is what the question wanted us to use for this formula. So if we drop down below, we have the contribution margin of $7,400,000 divided by $2,133,000, which gives us the DOL of 3.47. Moving on to part 2 of question 4, got the same format here. The formula is laid out right there. So again, we're going to start with the contribution margin of $6,475,000 and divide it by the total income before tax, which is $1,208,000, and that gives us the degree of operating leverage of 5.36. Moving on to the last part of question 4 and the last question on the PowerPoint, we have $8,787,500, which is the contribution margin, divided by $830,600, which leaves us with the DOL of 10.58 at our own sales force. So just to recap question 4 entirely, if we're calculating the sales commission at 15%, our DOL, or our degree of operating leverage, will be 3.47. If it remained unchanged at 20%, our DOL is 5.36, and if they were to employ their own sales force, again, the degree of operating leverage would be 10.58. So that is all for this PowerPoint. If you guys have any questions, please let us know. Tried to map out the work as best as we could for you guys, so hopefully it was easy to follow along. Thank you.